Good afternoon to everyone, and in fact, good morning to those in both the Mountain and Pacific time zones. I'm Ed Tuchon, Director of Business Development with Regent Revenue Cycle Management based in Chicago. Welcome to the second of 3 segments devoted to benchmarking exclusively in the ASC community. Before we do move in today's topic focused on revenue cycle performance benchmarking, let me give a quick introduction to the organization that sits behind the actual benchmarking program. So Regent Revenue Cycle is an independent division of Regent Surgical Health, a 15-year veteran in the ASC industry. Back in 2005, Regent Revenue Cycle existed as a central billing office supporting Regent centers, and in 2014, we expanded our services out to the entire ASC community, importantly maintaining an exclusive focus still in the ASC community. As the backbone of the revenue cycle team's focus on performance, benchmarking through key metrics has been an integral driver of the team's success and, I might add, our focus on continuous improvement. That's since the inception of the team over 10 years ago. One quick housekeeping item as well. Very similar to the first session, we intended to host an open mic event. However, we've got 65 registrants and, in fact, more joining as I speak, so we've decided to keep the session on mute. We certainly welcome your questions throughout the course of the presentation. You can submit those via the WebEx Q&A or certainly at the end as we open up the audio portion. So why don't we go ahead and jump in. I want to start with 3 questions that are part of virtually every conversation we're having today, and in fact, equally important, do help to frame today's discussion. So, question number 1. With no authoritative standard in the industry, what are the recommended revenue cycle benchmarks that drive the financial health of the center? Question number 2, do revenue cycle metrics operate independently or are they in fact integrated? Question number 3, what tracking and trending capabilities actually exist and how can I leverage to the benefit of my center? At this point in time, I'd like to hand the mic over to Mike Orsino, Vice President of Regent Revenue Cycle. Mike sits at the heart of both the monitoring and management of the performance metrics in our organization.
Thank you, Ed. To all of the new participants in the webinar, welcome, and to those who sat through our first webinar, welcome back. Continuing on with our presentation, we're going to talk about 5 metrics or KPIs, and you'll hear us use these 2 words interchangeably, and KPI stands for Key Performance Indicators. The 5 KPIs that we'll be talking about today include days outstanding, or sometimes referred to as days in AR, percent of AR greater than 90 days, claim lag or charge lag, statement lag, and denial percentage or claim percentage. I'm going to talk to you here about the Regent standard, but by no means is this should any of these standards be held as a hard and fast rule, because as you'll see, a lot of these metrics will vary depending upon payer mix, case mix, and sometimes acuity. So for days outstanding, days in AR, typically what we say is 30 days, but again, we'll go through this in more detail. Percent of AR greater than 90 days, our standard is less than 15%. Claim lag, charge lag, less than 3 days. Statement lag, less than 5 days. And finally, denial percentage, we strive for less than 10%, and a clean claim percentage, we strive for 98% clean. So let's take each one of these KPIs individually, and we'll go through them in detail. And for each one of these, we'll include a definition, the calculation, again, state our standard, and then the uses. So the first one, the most common one you'll hear, is the days outstanding. And the definition of this metric is, in its most basic form, it's essentially the time it takes to get a claim paid. So in order to calculate this metric, it's you taking your total AR. So if you just closed the month of March, you're going to take whatever that ending AR total is. And then depending on how you want to measure it, there's different ways to measure it, but the most common form of measuring this metric, and what you'll see as the standard in the industry, in most industries, is a rolling 90, and that really tries to take into account changes in charges. So you want just your average charges over that time period. So if you're doing a rolling 90, you take your total charges from the last 3 months. So again, if you're doing April, you would do your charges from February, March, and April, add them all up, and divide by 90, and that's your denominator. Now, some people measure it on just 30 days, so if it's going to be a 30-day, you just take your most common charges divided by 30. Some will do it on a 365, on the whole year. So you would just take your total charges for the entire year divided by 365. So it's basically your average charge amount is your denominator. Our region standard is, again, I said, less than 30 days. And the use of this metric really determines the health of your AR. If you start seeing wild swings from month to month, this may highlight a billing or collection problem. So going back to that standard of less than 30 days, again, that's just an average. Take, for example, if you're a facility, if you're a single specialty, let's say you're an endo center, or maybe you do mostly ophthalmology, your standard should be, you should have a significantly less than 30 days. We actually have a facility that's mainly endo, does a little bit of pain, and if we were averaging 30 days for this facility, we would not be doing a very good job. We typically average between 18 days and 22 days for that center. Likewise, we have another facility that has a Medicare population that's 75%. And again, we're in the low 20s for that, and that's what we typically average. So if we were around 30 for that facility, there would be something wrong. Contrary to that, we have a facility that's completely out of network, and we average typically around 54 days for that facility, which is really good because typically your out-of-network claims take much longer to get paid. If we were averaging 30 for that facility, I'd be highly skeptical of that number. So again, it all depends, and that number can be shifted based on payer mix or case mix. Okay? The next metric I want to talk about is the percent of AR greater than 90 days. The definition of this metric is the amount of dollars as it relates to your total accounts receivable greater than 90 days outstanding. The way to calculate this metric is you take your total AR greater than 90 days. So picture your buckets on a typical aging report, and you want to add up the dollar amount in your 90 bucket, your 120 bucket, your 150 bucket, and if you have 180 plus, you want to add all that up and then divide that by your total AR. Our region standard is less than 15%. The uses of this metric, a high percentage of AR greater than 90 may emphasize an issue with patient collections or insurance denials. So, if you start seeing, your total AR, your percentage over 90 at 20, 25, 30, 35% and higher, your collection staff or your outsourced partner may not be following up on patient accounts. Or maybe we're getting a lot of insurance denials that they're having to work. When you start receiving the denials, typically, they age much higher than those that are clean. Again, the standard, if you have a high amount of out-of-network cases, or maybe you're doing more workman's comp cases, you may have a percentage of 90 that's greater than 15, but your AR still may be in great shape. And conversely, if you don't have if you're fully contracted and you're doing a lot of work on the front end, doing it through patient financial counseling, 15% may be high. Maybe you're 10% or less. The next metric, claim lag and charge lag. The definitions, there are actually two separate metrics. The definitions are the time it takes to get a claim entered which is your charge lag, and the time it takes to get a claim sent is your claim lag. And the calculation is the number of days from the date of service to charge entry, which again is the charge lag, or claim submission, which is your claim lag. The reason we put both of these together is because oftentimes we'll come across a facility where they'll have a claim lag of, let's say, 4.5 days, I'm sorry, a charge lag of 4.5 days and a claim lag of maybe 5.5 days. If you're measuring both of these, these numbers should always be the same. They should never be separate. So when we see a charge lag different from a claim lag, that tells us that a facility is entering charges in and waiting to send out the claim. And there really shouldn't be a reason for that. Claims should be sent at least once per day, if not sometimes twice, so that the charge lag and the claim lag stay consistent. Our standard is less than 3 days. And so if you think about the typical process, once the patient is seen and the physician dictates, then we allow 24 hours for transcription and 24 hours for coding. And as soon as the codes are received from the coder, those charges should be entered and the claim sent. And we say less than 3 days because we understand that there's going to be, those rogue physicians who are not dictating in a timely manner. And, we laugh about this, but typically it's usually the physician and/or physicians who own the facility or who have ownership in the facility, and it's very hard to get them to change their ways. So, we do take that into account. That's why we say less than 3 days and not less than 2. The uses of this is it determines how quickly charges are being sent. A high lag has a negative impact on days outstanding. So think about it this way. If it's taking you 6 days to get your claim sent, so if your claim lag is 6 days, and you have a days in AR of 46, those 6 days that are of your lag are automatically added on to that days outstanding number. So if your claim lag was closer to 3, then that would be a very easy way to reduce your days outstanding by 3 days without doing much. So this is one of the easiest ways to increase or decrease your days outstanding is by controlling your claim or charge lag. The next metric that we like to measure here at Regent is the statement lag. The definition of the statement lag is the time it takes to send out patient statements. And that's from the date of responsibility, not from the date of service. So calculation is the number of days from the date of patient responsibility to the date statement sent. So think when the payment poster gets the payment from the primary or secondary insurance and it becomes the patient balance, once they flip that to the patient responsibility, that's when the clock starts ticking on the statement lag. And it ticks until the actual statement is sent out. Our standard, again, is less than 5 days. We typically run statements at a minimum of 1 time per week. That's why we keep it under 5 days. I think that running statements once per week is overkill, but we've seen it where it's only run once per month, and that can be a significant time lag between the time that it takes the patient to get the statement from when it became their responsibility. So the recommendation is to keep your statements on a 30-day cycle still, but by running them each week, you'll ensure that patients, the least amount of time, or the most amount of time they'll wait is 5 days from their date of responsibility from when the patient statement gets sent out. The uses of this lag is it determines the efficiency of your staff. If you start seeing a high statement lag, this will decrease your probability of getting a balance paid. The longer you wait to send that patient a statement and to inform them of how much they're going to owe, your probability drops of getting that paid. Finally, the last two metrics that we'll talk about, and we'd like to combine these, is the denial percentage and claim percentage. The definition is the percent of claims that are rejected by the payer, which is your denial percentage, and the percent of claims sent out without edits. Calculation is you take your total amount of denied or clean claims and you just multiply that by your total amount of claims, and that'll give you a percentage. Our standard is we shoot for 98% clean, less than 5% denied. The uses is a high denial rate could highlight issues with certain payers. A low clean claim percentage may pinpoint some issues with either your bill or front office. So let's say you're seeing a high denial rate. This is when, as managers or administrators, you look and you take the metric at a 10,000-foot view, and then you start to go 10,000, and then you go 5,000, 1,000, and you hone in on what could be causing these denials. And oftentimes you'll find maybe a certain payer has created a new rule. Maybe a contract has got renewed or gone into place, or a new rule. And with that certain payer, then you can start highlighting those issues with that certain payer, and maybe you can build some edits in place to decrease that denial percentage and increase your cycle to get paid. The clean claim percentage, again, if you're seeing a high amount of clean claims, a low amount of clean claims, then it may pinpoint your biller or your front office. Maybe the front office is putting in an ID number wrong, or they're selecting wrong insurance, things like that. When you start to get these metrics and you hone in on, then you can address them with the appropriate staff to either increase your clean claim or decrease your denial percentage. Ultimately, at the end of the day, once you know and you understand all these metrics, we talk about the KPI. And to illustrate this, we like to give this example. So if you take a look at the list of hypothetical ASCs below, assuming the charge masters are all the same, which one of these ASCs is in the best financial position and why? Is it A, is it B, or is it C? And I'm going to give you a minute to take a look at these, and then I'll respond. So in ASC A, they have a pretty decent days in AR. They have a high net collection rate. Percent of AR greater than 90 is low. Gross collection rate is 69%. B, you have a days in AR of very low of 23. Net collection rate 99. Percent of AR greater than 90, 6%. Gross collection rate is 63. Then you have C, a days in AR of 40, net collection rate of 92, percent of AR greater than 90 at 16, gross collection rate of 74. Most often we get B as the right answer because they have such great metrics. But this is why we like to highlight this. The KPI at the end of the day is cash, right? And so if you look at all three of these ASCs, number C, or letter C rather, they're collecting 74 cents out of every dollar, as opposed to B is collecting 63, A is collecting 69. So, you know, at the end of the day, I think all of us would rather have 74 cents on the dollar rather than 63 or 69. And so what happens is sometimes we see facilities may get blinded by metrics, and we want to highlight metrics are important, but at the end of the day, cash is king. And the most important number is how much money is coming through the door. So finally, now that we've gone through the metrics and you know the metrics, how do we monitor and manage the metrics? First, you want to leverage technology for real-time visibility into key performance benchmarks. You want to use a management information system that's specific to ASCs that'll be able to produce the reports and help you get to the metrics you need. You also can use some kind of next-generation reporting analytics or dashboard capabilities. There are some programs out there that can overlay most of the systems out there, such as HST, the Source Medical applications, AMCI. They can overlay them and pull all the data and slice and dice information any which way you need. You want actionable, customized insight to center data. to help you identify trends and issues, what we were talking about before with payers, for instance. And these really will drive that continuous performance that that we all strive for. As we talked about earlier, you want to establish the select key performance indicators, and then you want to benchmark these against industry performance. And finally, as I kind of mentioned in the first bullet point, if possible, you want that real-time dashboard or a management console to be able to manage in real time what some of these key performance indicators look like, and have that be fully graphical and fully customizable. I'm going to show you an example of a dashboard we use for our clients that gives some of these key performance indicators we talked about. As you can see in this, it gives a dashboard. So at any given time, you can take a look at where your AR days are, for example, or how many open accounts, or cash collected. And as you can see, this looks like a speedometer of a car. And what's nice about this is each of the parameters are fully customizable to a particular center. So going back to the first slide when I talked about, the standards, what we talked about, AR days, for example, on that first speedometer you're looking at. Your center may be, what if you're an endoscopy center with you're striving for 22 days or below? What you can do is that green portion we can set to 22 or below is the green, and maybe you'd want to set 23 to 30 as yellow, and anything over 30 is going to be red for you. And you can do this for each one of these metrics. And if you're cash collected, you set your goal there for your cash collect goal, and you can see at any given time where you're at with your cash collections on that month. Okay? Same thing with billed cases, billed charges. And we're able to, or if you use a dashboard such as this, not only can you look at key performance indicators on the finance side, and you can see there's actually more of them. We just didn't have enough room to show you the full thing. On the left side, you can see more key performance indicators: supply cost per case, credit balances, days to payment in full, things denial. There's your claims denied. But you also can look at clinical KPIs as well. For those of you that are clinically focused, these might be more up your alley. That concludes this portion of the webinar. At this point, we'd like to open it up for any questions or comments that any of you may have.
So, Mike, we have a couple questions flowing in. First question: is the standard of less than 30 days for a particular specialty?
This is a good question, and again, you probably asked this before we really got into the meat of it, but it's really a general. But if you're a multi-specialty center, it's a good starting point. If you're more complex cases and you're out of network, I would say that standard is going to be higher. But again, if you're fully contracted and are doing a lot of eyes, pain, endo, you should be in lower 20s.
Mike, next question. If a center policy is to take adjustments at the time of billing, do the metrics change? That's a very good question. So I think what you're trying to get at here is the difference between net days in AR and gross days in AR. And this is an excellent question. I probably should have mentioned it earlier. When we looked at those, the days in AR metrics, we were measuring gross days in AR, meaning no adjustments are taken at the time of billing. So, and this is the standard used when you see comparisons in the industry or any other industry, hospitals, physicians. Almost always you're seeing it as the gross days in AR. If you're taking the adjustments at the time of billing, the way you're going to calculate that metric is you're going to have to do your net AR, and that's going to be divided by the average net billed amount. And it's a little bit more complicated to do just because most people who are taking adjustments at the time of billing,
their AR is not totally net because they'll have some payers that may be out of network that they haven't taken adjustment for, so that'll be sitting as growth, or may have some other growth numbers there. So you want to make sure to do apples to apples, you want to make sure that your charges are net and that the AR, that you've netted out any of that, those gross amounts that may not have had an adjustment taken at the time of billing.
Mike, next question. Once I get a set of metrics established for the center, what do you recommend in terms of revisiting or even modifying those metrics on a quarterly basis, an annual basis?
I would say at a minimum a monthly basis, if not sooner. You know, if you have the dashboard, you should be looking at them weekly. Some metrics should be looked at more often. So if you're looking at some metrics we didn't talk about because there's no standards, but you can develop them on your own, such as your collections. You know, for your collections, you should have a standard that you set as a goal each month, and you should be looking at those weekly. So if you're halfway through the month and your cash collection goal is $1 million, and you're at $200,000 halfway through the month, you should be already looking to determine why the dollar's low. Other metrics such as days in AR, minimum of monthly, because that's typically when you run your AR reports and you can calculate your gross charges. Any further questions or comments?
Mike, I don't see any further questions at this time. So with that, we'll go ahead and draw this session to a conclusion. Thank you very much to everybody, number one, for bearing with us with our technical difficulty at the outset, but certainly for joining us today. The third and final session will take place on May 3rd, and we certainly invite you to join us for the wrap-up session, again, part 2 of the revenue cycle performance benchmarks. Thank you very much.
Thank you.